Howdy, Jacob here. Today we're looking at Lennox International in the building products industry. Just under 17 billion market cap with just over 18 billion enterprise value. Historically, huge return on invested capital, well over 30%, with growth in the mid-single digits. Pretty consistent. Outside of COVID, we had the two declining years pre and during, and then double-digit growth afterwards. So still averaging in that middle single-digit revenue growth range, with operating margins well above what they were 10 years ago, and gross margins 5%, almost over 4%, almost 5% greater than what they were 10 years ago, with earnings growing well above revenue and their dividend also growing well above revenue. So lots of good figures there. Balance sheet shows about 69 million in cash-like products and 1.1 billion in long-term debt, 150 million short-term debt. In relation to cash flow, that net $1 billion is probably about 2 years, maybe 2 to 3 years. We see about 400 million as their 5-year average free cash flow, roughly. So 400 million in relation to their 1.2 billion, about 3 years. So not a concerning amount of debt. Again, don't know when this is due. We're just looking at the numbers strictly, but just from what I'm seeing, not super concerned with that debt figure. Their use of cash is a little bit of reinvestment, a little bit of acquisition, but a heavy amount of share repurchases, debt pay down recently, and then that dividend pays out about 40 to 45% of their 5-year average free cash flow. So dividend payout isn't extremely substantial, and looks like they bought back quite a bit of shares 2021, same with 2019, 2018. Maybe went into a tiny bit of debt to buy that, but fairly decent use of free cash flow from what I'm seeing just from the numbers. I mean, obviously they have 20+% rate of return or 30+% return on invested capital historically, so I wouldn't want them to invest more, but there's just a lot of companies that if you buy back shares, firstly, that can inflate your return on invested capital number because that deflates the denominator of your return on invested capital calculation. So you decrease the denominator, inflate your return on invested capital. And then also, if they just don't have different things, actual things to reinvest in, then you're really not going to see that rate of return. They're just going to hand the company back, hand it back to the shareholders. And this company's been around since 1895. So, I mean, just because of that, from what I'm seeing from the history, they just don't have a lot of reinvestment opportunities. And so that's kind of what I'm thinking here and what I'm seeing. But I still think it's a very consistent business. People love consistency. That 28p kind of surprises me with a little growth, but to each their own. I think some people just see a high return on invested capital and immediately think, oh my gosh, this company is returning so much money back to the shareholders, which, I mean, they're really not. If you just buy back shares, and again, it's a concept you got to comprehend. If you're buying back shares, the only thing that matters is the price at which you're buying them at. That's going to give you the return you're looking for. So if you're buying back shares at like a 50 PE for a no-growth business, that's a terrible return on invested capital versus if you're buying back shares with a 5 to 10% growth rate and a 10 PE, that's probably going to be a decent return on investment. So your return on invested capital is, again, based on the denominator portion of your shareholders' equity from the balance sheet, which again gets deflated from buying back shares. And so, they're not actually getting this 40% rate of return. So the things that they're investing in, which is, albeit very little, could possibly be getting those rates of return, but they haven't been reinvesting. And so you're not going to get that type of rate of return, and you don't deserve that premium, personally. But let's just make some assumptions here. On the revenue growth side, I think mid-single digits I'm comfortable with. I think they have the possibility of reinvesting at high rates of return. It gives me just the babyest bit of premium for them. And then for margins, let's do 10, 9. I guess they have been growing. Let's do 11, 10. And then for share change, they're buying back a lot of shares. 1% would be about 170 million. With stock-based compensation, we're looking at 200 million. Yeah, just 1%. That dividends paying out about 40%. Let's increase that pretty much with this growth. And so we are leaving in this assumption roughly 20% for acquisitions and reinvestment, which they haven't really done historically. But I do think that that's probably best to keep into the assumption because I'm saying they're reinvesting to get to this 5% rate of return here. And then, yeah, it just looks expensive. I mean, again, there's no surprise there. It's currently 29 PE with the highest earnings it's had. And my revenue growth assumption is well below my discount rate. And so, I mean, simplistically, that's the concept. But again, I think I don't know why exactly this company has such a high premium because I do think people love consistency. And so if you're going to get 5% a year, people love Coke, people love Pepsi, they give them a premium. Do I think they deserve a 30 premium? Absolutely not. But do I think they deserve a premium? Absolutely. Because if you know what you're going to get versus what you don't know you're going to get, why would you not take what you know? Or you're 80% confident versus 40% confident. I'd well rather invest all else equal in the one that I'm more confident in. And so here it's just looking a bit expensive, but still an interesting business. Been around forever, so I don't see them going around anytime soon, being that they were founded in 1895 and are still growing fairly consistently. So we'll keep this on my list, but definitely not at the price currently. So hopefully you enjoy the video. Have a great rest of your day.